Imagine two investors with exactly the same knowledge. They understand diversification, they understand compound growth, they know that markets go up and down. They even know they shouldn't panic when stocks fall. Yet, years later, one has built meaningful wealth while the other keeps making the same mistakes. So, what happened? The difference wasn't knowledge, it was behavior. And this is one of the most overlooked truths about investing. The stock market doesn't really test how much you know, it tests what you do when your emotions disagree with what you know. Imagine you buy a stock because you've researched the company carefully. Then the market drops 20%. Suddenly, that confidence disappears. You start checking your portfolio every few minutes. You read frightening headlines. Someone tells you the economy is collapsing. Your mind starts saying, get out before things get worse. And eventually, you sell. A few months later, the market recovers. You knew markets could fall. You knew investing was supposed to be long-term. You knew panic selling was dangerous. But knowing didn't stop you from doing it. That's behavioral investing in action. Fear can make a rational investor behave irrationally. Greed can make a cautious investor chase a stock simply because everyone else seems to be getting rich. FOMO can convince you that being invested matters more than understanding what you're buying. And overconfidence can make you believe your latest successful investment proves you're smarter than the market. This is why becoming a better investor isn't only about learning more financial information, it's about understanding yourself. You need a strategy that can survive your emotions. For a beginner, that might mean investing consistently instead of trying to predict the perfect entry point. It might mean diversifying instead of putting everything into one exciting company. It might mean deciding in advance what your investment strategy is before fear or excitement takes control. Because here's the uncomfortable question. What happens when your carefully researched investment falls 30%? Your answer in that moment may matter more than everything you learned before buying it. The goal isn't to eliminate emotions. That's impossible. The goal is to build habits that prevent temporary emotions from controlling permanent financial decisions. So when you're learning how to invest in stocks as a beginner, don't just ask, what should I buy? Ask something deeper. Who will I become when the market moves against me? Because investing isn't simply a test of financial intelligence. It's a test of patience, discipline, emotional control, and consistency. The market may reward knowledge, but over the long run, your behavior determines whether you actually capture those rewards.